Um, This is on the Gold PC Exchange, and we're going to go through a couple of things. So first, introduce everyone, and then go through some intro stuff. So first, I'm Robert Fishman. I work at FHFA. I'm the Senior Associate Director in the Division of Conservatorship. My team, we kind of lead for FHFA the implementation of the single security, the related conversation platform, and related initiatives. So why don't we just guys introduce yourself in terms of what you do at your shop, and then we'll go.
Mark Hansen, I'm in charge of securitization efforts at Freddie.
Tim Kaviz, I'm the head of accounting policy and external reporting at Freddie.
And I'm Greg Metz. I head up tax at Freddie Mac.
As I think everyone knows, so Freddie Mac will be offering all holders of the current 45-day PCs the ability to exchange them for the new UMBS. And for non-TBA, 45 days for another 55-day non-UMBS. This will be optional at the option of the holder. It'll be open-ended, open for the foreseeable future, but it is a way for those who have the current security to join in the new greater liquidity that we see from the UMBS. When you do the exchange, you'll receive your parallel security to what you had. It's the same underlying loans, so everything you'll be getting back, same whack, wham, wallow, all the underlying stuff. Plus, you'll get a check for the value of the 10-day difference, i.e. getting paid on the 55th day rather than the 45th day. Freddie Mac has been working, along with FHFA, very closely with industry groups, the trade groups, individual firms, to kind of get together a process to make this as smooth and as efficient as possible. So let me just kind of start with some questions for Mark. Probably the first one is, so why are you even doing an exchange?
Why exchange? Well, if we go back to the early panels this morning, we talked about the goals of the program are to expand the liquidity. The fastest way to get from two markets to one is through exchange. As Robert points out, exchange is an option, so we built a couple principles into the whole thing. One was do no harm. So as Robert further pointed out, it's an optional exchange. You don't have to. The way that we've designed the exchange, by keeping the option open for the foreseeable future, should tether the old market to the new market so that the price performance of 45s should stay in touch with 55s. The second principle was to try to reduce friction in the whole process. So we've come up with a variety of ways, whether it's a dealer portal or an exchange program through the dealers. You heard in the prior panel, we're talking about coming up with perhaps other ways that you can turn your 45s into 55s. All that is part of trying to make it an easy process. And again, optional is the bottom line.
Do you want to give a little bit more color about kind of how some of the options are, what they are, and how you foresee they might work? And some of we actually heard from a number, particularly the last panel, is there some new ideas bonding about how to make it work?
So let's start with our original design and then where we are today. So, most of you in the room know what a giant and a mega are. Basically, you turn in QSIPs for other QSIPs. In the case of a giant and a mega, it's many for one. In the case of exchange, it's going to be a 45 for a 55. We're using this terminology of mirror. Every time you turn in part of that 45, you're going to get back the same QSIP on the other side of that. Those two are linked forever. And if you do it in different days, you get that same QSIP. If other holders, they all get that same QSIP. So when we sat down to design the first path, which is the dealer path, we thought, well, this looks a lot like a giant. So let's build it like a giant. And so what we did was roll out a portal, which basically lets dealers practice using this portal in giant space because it's really good training for doing it as an exchange. Also, in a giant, there's a wire that moves in one direction. In the case of the exchange, the wire's going to move in the other direction. We thought that would all work. And what I'll tell you today is, and it still will, for dealer positions. That holds together. We're going to continue to further disseminate that throughout our dealer community, and that will be a place where we expect maybe the majority of exchange to happen. But as we learned and discussed in the earlier panels, buy-side custodians had a couple of issues with all that. One of which is they have to keep their hand on the collateral throughout the whole process. Especially 40 Act companies have requirements where that needs to occur. And so what we've been talking about, is there a way to do that exchange, and what's allowable from that side of the equation is an ability to do that exchange directly with Freddie Mac. So we're exploring two different paths of doing it. In addition to the dealer path, two separate paths to go direct. We've talked about with special, and let me just use that air quotes, special, customers that are very simple and very high credit quality, meaning central banks. We've offered to go direct with them. There are not a lot of sub-accounts. They're of the highest credit quality. And so we thought that we could work that same exchange directly with them, and we still do. The most troublesome account, and I think it's represented in the room fairly, are money managers. And some of the largest money managers could have thousands of sub-accounts. And so that's the path that is under the greatest work right now, construction. So for the last several months, we've been pulling together work teams 3 hours at a time through the help of SIFMA and all the industry players that would be part of this to try to solve the varying needs of the custodian, the dealer, and the issuer in all of this. And so I'm optimistic that we're going to get to that. Today we can't give you that workflow yet, but hopefully the next time we meet we'll have that for you.
Thanks, Mark. Just in terms of timing, so once we have it all figured out, when do you expect the exchange to, quote, open up, that people would be able to first do it?
Right. So timing has always been the question, right? Now that we have a settle date, when is the trade date is the question. As we all know, the forward markets, by definition, trade in advance. There's heavy volume, 30, 60, sometimes 90 days. We've even heard from some lenders that go out 120 days, which was surprising to me. So if you back it up that far, you're talking first quarter, certainly next year. What we thought about is, well, those are trade dates that can be put on. Should we start exchange that soon? And as we dialogued with the industry, we came up with, well, let's at least do it a month before to manage the capacity issues. So imagine the May reg date. I don't know it offhand, but middle of the month. We would presume that A and B would go by as reg dates, and then we would open up the exchange. Now, part of the design, again, is there's no need to rush to the front of the line in all of this. You don't get a better deal by getting the first exchange done. What we hope to do is get the vast majority of the exchange done in the first several months and then leave that option open for time. But because there's not an urgency to do so, we think that that'll help modulate some of the volumes. What we've heard anecdotally is buy and hold investors, and I know we had one or two on the prior panel, have said, well, we want to make sure this process works. There's not a hurry. Our buy and hold portfolios don't need to exchange for trading's sake. So we might wait and let a couple months go by and see how this all settles out. What we've heard from more active money managers is we want to be ready to seize trading opportunities in the moment. And so I suspect they'll be front of the line. If I could just mention one more really important investor, it's the New York Fed. The New York Fed owns 40% of the securities that could be exchanged in this process. Now, you know, they're a unique investor. Some of you in the room look at them as part of the float, others don't. Because, you know, the intent has been that those bonds have gone away, they'll amortize over time. And so, you know, an open question that we keep asking is, how important is it for the Fed to turn in that 40%? I would offer, at least for optics' sake, that shows you right away from a prepayment standpoint where the bonds are. If they were to exchange, that would give you a sense of a bigger market right away. But it may not matter depending on your situation, whether they exchange or not, given kind of how you bench against any of the indices that we'll talk about later in the day, or how you think about what's outstanding in supply.
Yep, good, thanks. We know there's some important regulatory issues dealing with the exchange. I'm going to do first glass half full, then half empty. So first half full. So we know that the SEC had to issue some accounting guidance for the exchange. Tim, can you give us a color on what the issue is and then how the SEC came out on that?
Sure. Through the exchange process, we're now taking a 45-day and exchanging it for a 55. So there's a question about how that should be treated from an accounting standpoint. Is that the sale of the 45 and the purchase of a 55? Is it a resecuritization, and would it be viewed like a resec, and would you account for it how you might account for a resec? Or is it simply a modification of the arrangement? Generally, in the accounting guidance, the way you would look at this is either it's a modification of the original arrangement, or it's an extinguishment of the old and the issuance of a new. And they both have different consequences. If it's a modification, you carry over the existing arrangement and count for it as though nothing's changed. And if there's a cash payment between the debtor and the creditor, in this case, Freddie Mac and the investor, you would just treat that as a basis adjustment that you would defer and amortize over the life of the security as an adjustment to the yield. If it's an extinguishment, you are extinguishing the old and have a new arrangement. So that's purchase and sale accounting, so that would trigger gains and losses. So we approached the SEC with this and said, look, you know, there's different ways of looking at this. Different people could analyze it differently, but we think in this fact pattern, it's very reasonable to say all we've done is modify that original arrangement. Nothing else about the security has changed. The timing of the cash flows by 10 days is the only thing that's changed. The whack, walla, wham, everything is the same. And so we pitched that idea, and the SEC agreed that they would not object to that conclusion. So they view that modification accounting is the reasonable interpretation of GAAP. So no gain loss. The cash payment that Freddie would pay for the float differential, that would simply be a basis adjustment that you would amortize as an adjustment to yield.
Great, thanks, Tim. Now under the glass half empty, an open issue also deals with how the IRS would treat the exchange, which in the IRS lingo would be called a conversion. Greg, you want to give us some color on where we are on that issue and the status?
Yeah, thank you, Robert, for setting me up so well for that. Anyway, we have gone to the IRS and asked a couple of different questions. First of all, we wanted to get clarity around how they would view the exchange itself, and then second of all, how they would treat the make-whole payment as part of the transaction too. We actually sent the letter into the IRS roughly 9 months ago with the idea that we wanted clarity for the entire industry. We wanted something that was published so that people could rely on it. We asked that they rule that the exchange itself was a non-taxable transaction. We believe the tax law is very clear in that area. So we expect at some point in time to receive that guidance. On the make-whole payment, we also went in and asked them to give us guidance on that as well. We did indicate that we thought the best way to treat that was actually an adjustment downwards in the tax basis of the security and not recognizing the income up front. We did also throw out an alternative because oftentimes when the IRS sees that you receive some type of cash payment, they oftentimes like to say that's taxable income at that point in time. So they may come out with that position as well. So we've gone in, we've asked for those two rulings. The Treasury issues every year a priority guidance list, and we know that both of these issues are on that list. Unfortunately, in terms of timing, we also had one of the biggest tax law changes in the last 30 or 40 years. And so we're getting put behind some other things that might be a higher priority at this point in time.
Any idea when they might issue that? Or?
We are continuing to push on this. We reach out to them regularly and ask for guidance. We do believe that the IRS has actually gone through at least the issue with regard to the exchange. But it has to go through both the IRS and the Treasury, so we have to wait for the Treasury to sign off. So we're continuing to push.
Okay, good. Mark, maybe back to you. How would you encourage PC holders to prepare for the exchange, given the kind of open items that are out there?
Well, let me go back to that do no harm principle. I think that applies in all cases. We have every expectation that this is going to be a smooth and seamless transition, but if it's not, you got to be ready for it. And so part of getting ready for it is knowing your upstream and downstream partners in all of this. We had a panel earlier this morning that talked about kind of the utility of TBA. And when you think about the utility of TBA, it's about a third of this room right now. It's all those providers that make for netting, clearing, analytics, pricing, measuring. All of that is part of the utility. And so what's most important is that I think June 3rd is a Monday morning, right?
Yep.
So over the weekend, waking up June 3rd, Monday morning, that your position reports are what you expect them to be. That all your bonds are priced properly, that you understand your duration, convexity, volatility. All the dimensions of understanding your position need to be there that morning. And this is regardless of whether you exchange or not. You just need to know that all lights are on in the dashboard and all of that. And so that involves what we've been talking about throughout this day of knowing your upstream and downstream providers. Where does all that information come? Aladdin is a big one, but so are the pricing services and EMBS, and again, much of the room. So make sure that your position is continuous. Step 2, I think, is being able to trade that position. So now it becomes a question of your position and you want to seize on opportunities. You have to make sure that that portfolio is ready to do so. So that is as much of an internal as an external exercise. Make sure that your back office knows how to process those trades, that they know how to do the exchange and to work through all that. Later in the day, we're going to have something called a tabletop exercise. And that's about as close as I can get to understanding the breadth of this exercise. At some point, and there'll be more detail this afternoon, we're going to try to get the whole industry to kind of sit down and think through the process flows. How do things happen? How am I going to get my morning prices? How will trades and exchanges be executed? How will that be presented as we compare ourselves to the indices? So all of that requires understanding each other's handoffs, timing, You know, I'm hesitant to call it Y2K because it's not a moment in time, but it's pretty much a weekend in time where you have to make that switch from, on, let's say, Friday, the last day of May, or the last trading day of May, FNCL and Bloomberg will look like a Fannie position. On Monday, FNCL will be a Fannie and Freddie position in all of that. And your systems have to be alert to that, and we all have to move together. So that's big picture, but I just want you all to start to have a sense for it's not just internal in your back office. It particularly involves vendors and handoffs.
Great. Well, like the last panel, we have some polling questions for you. So can we have the first polling question? I wasn't given a clicker. Oh, here we go. So you see the question? All right. So kind of interesting there. So obviously number 2 got the winning bid there, 3-6, but then kind of more evenly spread between 1, 4, and 5. I don't know, any thoughts on this, or is it kind of what was expected?
It depends who you are.
Yeah.
Right? Is there an urgency to exchange or not?
Right.
And I would say for buy and hold, you know, those assets, they're staying on your balance sheet. Whether they show up on a 15th or 25th payment is of lesser consequence. The return should be the same. So it's not as urgent there. But I think for the active money managers, the ones that maybe would move a position a couple of times a day, you need to be exchanged.
So on the 19% that says, you know, immediately, will you and the systems and processes that are needed to handle that type of volume be ready to go? So what, there's about 1.3 trillion gold PCs, giants that are TBA eligible outstanding. If 20% of that knocked on the door on day one,
Right.
would, at least would your side of the equation be ready?
If they were all in whole pools, yes. Here's our great dilemma in all this. We can do 50,000 transactions a day with Fedwire.
Through the portal for this process?
Through the portal, right. And if I have the numbers right, ballpark, there are about 73,000 pools that are eligible for exchange. Now, keep in mind that if a pool is in a REMIC, it's not eligible entirely. Or if it's a pool in a giant, sometimes our giants are nested several dozen times, only the resulting pool is available. So think of the population of 73,000. What we don't know is how many people own pieces of those 73,000. Or if you're a large money manager, you bought that one large giant, but you stretched it across 400 accounts. Will you bring us one giant, or will you bring us 400 pieces? Because if you bring us 400 pieces, all those count against our 50,000 a day budget, if you will. We've asked the question. I still don't think the industry knows the answer. But the more that we talk about it, it sounds more like pieces will be coming in, not large chunks. And so, again, that's going to probably stretch this out. We'll work, hopefully, through these other alternatives. We've got kind of the highway built. We're building some side roads now, if I could use that analogy. Hopefully, those side roads up our capacity in all of this. And, you know, that's what I can tell you at this point.
Okay. We have a second question, if you could turn that one on.
Robert's right.
Yeah, not surprising. And then the I don't know is the second place. So I don't think that's surprising.
No, I don't think so either.
Yeah. So we have time now to open it up for questions from the audience. There are folks walking around, I believe, with mics. If anyone has a question, please raise your hand, and we'll be happy to see if we can answer them.
The OS-based compensation scheme.
So the OAS composition.
Yeah,
for the
that's an
payment.
important topic. Thanks for the question. How do we decide what fair value is, right, in all of this?
This is for the 10-day change in the delay from 45 to 55 day, the payment that Freddie Mac will pay to current holders.
That's right. And let's walk it back a little bit. So when you turn in a QSIP, it's on a given number of loans. What you would get back is a different QSIP on those same loans. So if you own low loan balance or any kind of spec pool, you're going to get the exact same cash flows whether you exchange or not. It's just the timing that matters. So we took that concept into the kind of the design of all this. The notion is you have an asset on your balance sheet today at a given return. We want to return that 55-day at the same return. OAS is one of the most common metrics of return. We could have used even yield. We chose to use even OAS. So what we're going to do every day is take those 45-day cohorts, the Freddie Golds. We're going to create a grid of fair value. We'll take those cohorts, we'll run them as 45s with a given price, hold the OAS constant, change the delay, and pay you the difference in price that results from all that. That should give you the same return by definition on your balance sheet, if you will. What we're going to do is recognize that not all the market is just generic TBA. There's a lot of specified pools. And those will be the ones probably most important to return back to balance sheet because of the scarcity value. And so what we'll have is a grid for cheapest to deliver. We'll be using a Bloomberg framework. They just recently reformatted all their cohorts. There's an all category, all the spec categories, and what results is, I think they call it WTD, worst to deliver. So we'll price the worst to deliver every day in addition to all of those layers. If you had a low loan balance pool, we'll go to the worst to deliver pay up. Today would probably be about 3 ticks, let's say. There might be an extra plus or an extra quarter tick if it is a specified pool somewhere in there. We'll add those two together. The way that this portal has been created is kind of like a grocery store where you can check yourself out. You bring your QSIPs to the front of the line on your own. You run them through the scanner. What it presents itself to the dealer is an electronic trade ticket, and it gives the dealer the ability to hit confirm to lock in that trade. And once you do, then that executes the trade and all of that. And so I think it was mentioned earlier in the day, Bloomberg is going to give you a tool to look at individual QSIPs, run them at 45, 55, and give you the float comp. That'll be a check against our daily grids. We also have a tool that's similar to that that'll be on our public website so that you can run a portfolio that same way. So the whole idea is to keep it as even return on your balance sheet, but just give you a 55-day payment instead of a 45-day.
So again, by cohort, these will be publicly posted so people will be able to see and then updated daily as need be.
Yeah, thanks. So I think our current thinking is we would update the prices at the close of every business day, and that would give people time overnight to construct those trades if they like them. They begin with choosing a settlement date, and then it's all constructed via the dealer path right now. We'll see if those other side roads develop what that looks like, but it'll follow the same pricing in terms of float compensation.
Looks like there's a follow-up question.
Yeah,
Yeah,
the
go ahead.
follow-up question. So the underlying model, the prepay and the term structure model, Freddie Mac will be using, do we have any clarity on that yet or no?
Now, it won't be a Freddie model. We chose to use Bloomberg, and now they're implementing the Barclays valuation process. So it's, I think it's BVAL is the pricing framework. We will be moving with the market. Again, part of the design was not to create any kind of bias or skew, ours, theirs, yours. So we chose probably the most ubiquitous, middle of the market kind of model, which is the Bloomberg model right now for OAS. What you will see is, and we've tried this, even if you choose vectors or your yield or any kind of alternative path, it comes very close to the same number. Discounts and premiums are a little bit off, but we're all talking about a fraction of a tick in terms of delta.
Other questions? Right there, I see one.
Hi, I'm a database administrator at a firm that does mortgage analytics, and I was wondering if you could comment on the single security initiative with regard to legacy securities. Specifically, I have users who are unhappy with the elimination of documentation data breakouts, like income verification, employment verification. So I was wondering if you could comment on that, the fact that that's missing from the new single security initiative.
I hear at least a couple of questions maybe in that. One is, what will the documentation or the disclosure look like?
Disclosure.
Right? And so what Fannie and Freddie have done is spent years aligning what we call now our standardized disclosure, where in many cases we were capturing the same fields, but we had different enumerations. Like Freddie had a 1 through 6 and Fannie had a 1 through 10 of different choices you could pick in each of those fields. That's all been standardized. Not much was lost or left behind between either of our initial disclosure fields or the number of fields and all that. All we've done now is kind of standardize the formatting and the way that it gets displayed. We adopted that last summer. Fannie will be adopting it next summer. But starting with single security, we all have the same data. Another question that I heard in that was kind of old and new. So let's take a 45-day gold QSIP that's owned by Robert and I. Robert chooses to exchange and I don't. So what you have now is still some existing 55-day and 45-day out there on these same loans. What will be new to the market is understanding how much is out there so that we don't double count or miss any of this. So I think Larry Goya from EMBS mentioned earlier, might have gone past some, which is we're going to have these L1 reports. L1 stands for level 1, which will tell you what's outstanding across the board in terms of all of our QSIPs. What you'll need to do going forward for a while is today you pick up on the 4th business day Fannie and Freddie prepay reports and you compare them. They're not going to be aligned day 1 or month 1. What you'll have in Fannie space is an entire seasoning of $3 trillion, and in Freddie space, whatever came in for exchange and a couple of new bonds. So the seasoning will be very different. In order to make Fannie and Freddie look alike, you'll need to compare the old 45 plus the new 55, and that way you can compare Fannies and Freddies. And so what you'll get from Freddie is 3. You'll get the 45, the 55, and the composite reports going forward. So from a database administrator standpoint, we're going to do what we can to help you understand that. Every day we're going to tell you what gets exchanged from one QSIP to the next. We'll have these roll-up reports, and we're also going to give you some check tables so that when you run your queries, you can see whether I'm double counting or eliminating against each cohort. And that's the best we can come up with. We're open to other ideas too.
So I also heard
in
a
other
question
words,
on some specific fields, is what I heard also, of income verification, low no-doc. I'm going to paraphrase what I think your question was, is those were, for either Freddie or Fannie, one or the other, or maybe both, disclosed fields, and a question, are they going to continue to be disclosed fields going forward? Was that also in your question?
Well, yeah, that was the main point, is
Yeah,
that
yeah.
it seems to be missing from
The-
the single security initiative. I don't see anything in there
Okay.
about
So I-
income verification or employment verification.
Where those are required data fields. So do you?
So I'm looking in the room. We have some people that know the data a lot better than I do. Art Frank from Fannie Mae has a mic. Let's turn to Art.
Sure. So I think Freddie used to disclose the asset verification, but when we decided to standardize, we did remove those fields just because everything that's delivered to our companies today are fully verified. So we thought it was kind of a redundant field to keep.
What about the history?
So just going forward, that's what we decided to do. So you should still have the history from the previous disclosures that were done by Freddie Mac.
Okay. But it won't be in the going forward disclosures. Thanks, Art. You're good.
Yeah, I
That
have
table's got a lot of
follow-up.
questions.
So basically, also on the disclosures. So with the new format, with the new with cash out, is Fannie Mae going to be publishing the cash out percentage for all the legacy securities in addition to the new UMBS?
It's just going forward.
We are. So anything that was existing, we will be breaking out the.
Okay, and that'll also hold for things like defaults and delinquencies?
There's going to be certain fields that it's only going to be disclosed going forward. When we put out our documentation, you'll see which data attributes will be going forward versus which ones will actually go retroactive.
Okay, thank you.
We get both questions and answers from the audience. Nice. Okay.
They don't need us.
Yeah. Other questions? Someone over here?
We have both sides.
Is there any clarity what the Fed is going to do with the exchange?
Yeah, sorry,
The Fed clarity over exchange?
No, we do not have, no information on that.
Right.
Is there someone over here?
Yeah, so I'm going to go back to the mechanics of the exchange, and I know you said you haven't quite figured out how you're going to do the exchange with the money manager side of the business, but in your conversations with the dealers, one of the options is these exchanges will happen, with the dealers. In your conversations with them, is there an expectation that they are going to be compensated for performing this function of the exchange? And if so, where is that compensation coming from?
Dealers, that is.
Right,
Will
right.
dealers be exchanged?
If money managers exchanged not directly with
Right.
you, but through the dealer network?
Yeah, the original exchange mechanism through the dealer process is a service, is what we were asking our dealers to do. Like we do today with Giants, we don't pay dealers to facilitate a Giant. We post our fees on public websites and on Bloomberg, but there's no expectation that they take anything out of the trade. That would be our expectation here as well. We have other ways of recognizing the liquidity and distribution the street provides, but we didn't want to bake it into this process because, again, we were trying to return the asset at the same return.
Other questions? I know we're standing between you and lunch, so that could be an incentive. Okay, if not, well, thank you, thank panelists. And again, lunch is next, and then there'll be a panel.
One more question.
Oh, there's another one. Please do,
In
sorry.
regard to the
One more
exchange,
topic,
is there anything in regards to testing timeline or something like that that might be needed? You mentioned how it's going to be similar to the Giant creation process. Is there anything technically different that we should be looking forward to?
Well, a couple things, and maybe this bears repeated mention. So, a couple things that are stumbling blocks with the money manager exchange right now. One is we still don't know what the tax treatment is. So again, if this goes down, I think it was mentioned at earlier panels, if it were to be taxed, then it starts to look more like a trade. And if it looks more like a trade, then it starts to go down more kind of existing paths that are built for trades. If it's not treated as a taxable event, well, then it's something a little bit more unique in all of this. And so that sounds more like we have to build a different path such that we don't trigger 1099 reports and all the accounting statements that result from all of that. So getting that tax clarity will be step one. Step two, I think it might have been mentioned earlier too, was there's a legal aspect of kind of, for 40 Act companies, keeping your hands on the collateral. And for us to know our customers, or know your customers, the KYC topic. And so what we didn't anticipate was the necessity of custodians to keep their hand that way. They keep looking at this exchange as something similar to a corporate action, but not all of us are, because corporate action has some rigidity in it that's not part of the design. So that's where these work teams are coming in, and we're coming up with some solutions around all that. I think the tax answer, and then a little bit better sense of how we can navigate sub-accounts is really what needs to be solved for.
Good question.
I just had one more thing, and we
Please
failed
do.
to mention it, is we've talked a lot about TBA, and TBA is the point of all this, but Freddie Mac is turning all of its 55-day into fixed rate. I'm sorry, all 55.
All 45.
Thank you,
into
Robert.
55.
All of our fixed rate is going 55-day delay. And so we'll be offering exchange for non-TBA in the same manner that we're offering it for TBA. So you can think of Freddie going forward as finally aligning on the same payment delay as Fannie for its fixed rate products.
Okay. With that, thank you.
Hey,